Welcome back, everybody, to another video of the trading journey where I journal on a weekly basis how I've done for the week, and we go over the failure, the wins, and what we're going to do going forward, what we're going to implement going forward in order to become a better trader to get to the goal of being a successful trader, a successful, profitable trader. So, what we're going to do is I'm gonna show you the report, the weekly report. Let you guys see for yourselves how I personally did this week. And here is here is March. Now I do want to talk a little bit about February, how it went. You can see I had 10 good trading days out of the month of February. There was 28 days in February, there's 31 days in March. I should have more good days in March than I did in February. I don't have to trade every day, and that's the thing. So I'm going to start implementing that mentality that not every day I have to trade. If I don't see something for the day, then I just have to step away and do something else, read my book, focus on the insurance business. Um, take my mind off of the charts. Um, or just study the charts, study what happened maybe last month or 2 months ago even. Journal more if I don't see any setups that are active or could be active for the week. So last week we can see this is how the week went: -4, plus 108, plus 26, negative 140, positive 125, positive 82, and then the last day of the month last week was the Saturday, which was, oh, not last day of the month. This was actually still last week though. It was the Saturday. Last Saturday, I ended off with negative 43 because remember that day I did invest into Bitcoin, which didn't end up well. But at least um I got the idea of the market with Bitcoin um on this account, this live account. So based on last week's profit, I actually made $153.21. This week, I lost $318 and about 55 cents. So not a good week. Um, Obviously I could have done better. There's things that I could have done way better um than I did last week. There's rules that I broke this week um that I shouldn't have broke, where I wouldn't be in the situation that I'm in right now. So my net P&L down, even more down. My net daily P&L from started from here, went high, started going low. The green, obviously, it started going high, and then boom, crash, starting going back down. So it's obviously not good. And I'm gonna share with you guys what I think will help. I know should help if I make the right adjustments into the trading plan and stick to it going forward. And then a couple of things on the reason why. You can see based on my last trading video, I mentioned sticking to 25 maximum trades for the week. It's 50-50, 50% of the reasons why you're going to see more trades than I wanted to hear, and 50% of the reason why obviously I have to take accountability. All right, hopefully you guys can still see this. Okay, so there's going to be 50% of the reason why you're going to see why I traded more than I should have, and then 50% of the other reason is me taking my accountability for I should have stuck to what I said and traded less than 26, at most 25 trades. So let's talk about the difference between static risk and dynamic risk. I've since I started journaling, I've been taking dynamic risk. There was times when I was at 50 trades for the week or 59 trades for the week. I wanted to break that down, went from like 59 to 49, went from 49 to maybe 39. But it's been like volatile, and at least I'm aware of that. First step of being wrong is noticing that you're wrong and then improving. So building off of the wrong that you're doing. So at least I'm aware that I'm doing wrong and I'm holding myself accountable because that's a start in order to start becoming better. So again, static risk versus dynamic risk. So with me currently in static risk, not, I'm actually haven't currently been in static risk. I've been, like I said, doing dynamic risk. And this is not really recommended. It's really not a good idea because it could create more work than you have to, implement into your trades. Definitely don't recommend it. Let's say, for example, I want to risk 2%. You can go in with four different positions of zero point 0.5. So you can have one trade that's zero point 0.5, another trade that's zero point 0.5, another trade that's zero point 0.5, and another trade that's zero point 0.5. These are all going to be lot sizes. In order to be equivalent to risking 2% on your account of whatever, could be risking 2% on $1,000. And if you were to go the static route, then the static route would just be, I'm going to put percentage signs here. No, zero point 0.5. The static route would be 2.00. So 2.00 is going to be 2%. So this is the difference between static risk and dynamic risk. Dynamic risk is equivalent to X, which is going to be the amount that you're willing to risk, the percentage, and static risk is still going to be equivalent to X, which is the amount that you're willing to risk. So I will start using static risk. Now, if you are doing dynamic risk on trades, that could be, let's say you're going into drawdown and you're starting to get the sense that the trade isn't really going in your favor. Let's say all four of these positions have you at like negative $25, negative $30. You can start chopping away at your losses. So you can close out your one of the point 50s, one of the point 0.5s, um, so that you are risking less than you want to. So if the total of the 2% is $20 for the $1,000 account that you're risking, um, then you can cut out one of the point 0.5s by taking out $5 from you risking. Or, it would have been $5 if you were to keep each point 0.50 in the equation of you risking. I don't know if that makes sense. It's kind of hard to articulate, but I think as a trader, once you start understanding like lot sizes, it becomes more easier to understand. Like if you go in a trade with four positions to risk a total of 2%, then that would mean you're risking point fives, 4.5s. If you want to risk the same amount with static risk, you're gonna do a 2.0 lot size on $1,000 account. So that is that's I will start doing static risk instead of dynamic risk because it's easier and it will also make sense for the reasons of why these trades would make more sense based on the YouTube videos that I create every week. Instead of having like, five trades to risk the same amount that I would on a static account versus the dynamic account, it's gonna start making sense. Like this is gonna drop down significantly. This I think is what 10, that's 12, 12 plus. That's about 28, 28 plus, 28 plus, that's 38 plus 28. This is about almost 55, maybe around like 55 trades for this week. That's double what I wanted. So, and that's also due to, like I said, the dynamic risk. I'm going to start implementing the static risk so that that lowers the amount of trades. Also, while also maintaining the same amount of risk that I'm maintaining, I'm also going to cut down the amount of trades that I'm taking because I'm going to focus more on stronger setups. What I've, what's different or what I should have been doing, um, I think is working based on like my winning trades. I'm going to show you. This is the live account. I'm currently up only like $7 on this trade, but you can see how this week went. It says negative 210 because I did catch a W on US 30, NASDAQ, but if you add all together like the wins and losses, that's why it comes down to negative 210 for the week. Where's that USD CHF trade? Oh yeah, now we went into like last month. I don't know why it's showing last month when I did the filter for this week, but who knows? The USD CHF trade that I showed you guys the other day though, look at that, 107 profit, P&L, net P&L 105. So this is after the fee commission. So I'll start taking trades like that USD CHF trade, and I'll share with you guys one of the major things that I've learned truly like genuinely works when it comes to spotting out what trade is most likely gonna go in your favor. And I'll show you guys I'll show you guys that right now. One second, let me find it. Okay, here it is. So that trade that I took, which was all the way up here, looked like this. So this was how the trade looked. And I took profit down here. I could have held it, and instead of having like a 1 to 3, I could have had a one to, it could have been a 1 to 7. And one of the major things that um is a reason for why I would consider taking more trades like this is because I'm starting to learn that price in the past, if you look at the daily structure, it is way more respected. It's highly respected if you start looking at how many times it was, you know, above as a support and then below as resistance. So this would be considered actually trying to find. Oh, here it is. Comment. I'll do a comment. I don't know where it went. Okay, so this would be resistance and then above your area of interest would be support. So you'll start to notice that you should buy, sell. Your trade idea is more likely to be respected in the markets when you start focusing on where the large transactions are happening in the market. As long as your directional bias makes sense, it also makes sense to start looking at where the money is being exchanged. Where are the agreements between buyers and sellers making most of their orders? Um, this is definitely something that I'm going to implement more rather than just, um, going into the markets just because the directional bias on a lower time frame is doing, something that looks interesting, like a market structure shift or break of structure. Yeah, so that is my take on what needs to improve, what I will improve, what is working, what's not working. And this is one of the major things. So I'm sharing one of the major things that is definitely going to improve in my trading. I imagine it's going to improve in your trading if you start looking at these things. Prices under the EMA, the 50 EMA is what I use on the daily time frame. So once you start just compounding these things, you'll see um, your profits start to go up, focusing on higher time frame directional bias. Understanding the directional bias from the higher time frame is one though. That's like the first step. First step is to understand the overall directional bias. Once you know that, then you can start, you know, um, taking everything into account, adding to your confluence. And there goes like, understanding a couple other things, but I think these are one of the major things to start understanding because you don't run the markets. The retail industry, the retailers who are trading like us, like me, like you, um, are only about 5% of the liquidity in the markets. So we're not the ones moving it. It doesn't make sense to, go based off of each other's ideas. It makes more sense to just focus on the bigger players, the bigger institutions that runs their footprints in the markets, see what they're doing, what they last did, so that we have a better understanding on whether our idea should or should not go into the direction that we anticipated going in. So I hope this video was insightful to other people like you, if you are a trader or if you are thinking about being a trader. Um, like, comment, subscribe. If you have any questions, comment down below, and I will see you guys next week. Enjoy your week.